Hi folks, it's Dr. Jeff Camarda with a word from Jeff. This one focusing on the fact that the investment markets have been on quite a bit of a roller coaster since the September rally, with a continuing trade war, instability in the Middle East, and political drama with the impeachment inquiry all contributing to some really sharp market bounces. The mid-October China deal has fueled some optimism, and even though it's just a partial baby step agreement, it let some air out of the trade tension balloon and given investors hope that things may be on the mend. Finally, on the mend for international trade. The hope is sorely needed as recession fears and signs of recession have swept the globe, and even U.S. economic data has looked pretty soft lately. Not really soft, but there are a lot of soft spots. So soft, in fact, that the Fed has hinted it may cut rates yet again after having already done so a couple of times this year. In fact, I would bet on a rate cut probably by the time you see this. Progress on the trade front is comforting, even if it's very incremental. While Mr. Trump has long maintained he wanted one big deal, taking it piecemeal is better than nothing, even if it's probably being done for political reasons. With the U.S. economy teetering on the tipping point of a recession path, the last thing Team Trump wants is a clearly slowing economy going into an election year. That's the old, it's the economy stupid mojo, which is what sunk George Bush the first in 1992, and Trump has danced pretty close enough to the edge to risk that problem now. Now, doing a partial deal with China will probably be better for China than a grand bargain, but probably better than the risk for us and everybody else that China walks away to await the results of the 2020 election and maybe gets a more accommodating team than Trump, the Trump team, that might make more U.S. concessions than Trump will have to make now. In any event, the news is good for the market. Interestingly, building recession fears seem to have jolted investors into the reality that earnings, dividend payouts, and fair value matters again. About a month ago, Barron's noted that the long-awaited shift from the go-go growth stocks to good deal value may finally be at hand. It used to be that stocks, I quote, that got too expensive would eventually sell off, and that stocks that sold off too far would rebound. But over the past decade, pricey momentum stocks have gotten pricier and value stocks have stained the carpet. Then, during the last 3 days of this past week, again quoting Barron's a couple of weeks ago, momentum stocks sold off by 10% and value stocks rallied 7%. That was one of the sharpest 3-day shifts in 30 years, end quote. For most steady periods, value stocks have soundly beat the growth stocks that now seem to dominate the S&P 500, with value's long-term average annual returns something like 50% better than growth. The past 10 or so years have seen value way underperform, but this may finally be changing. In the past, when performance leadership has shifted from growth to value, value has outperformed by a lot for a long, long time. Based on history, if and when this shift occurs again, and it may be happening now, I think it is, the value bounce may be particularly valuable and powerful. Given that Camarda's investment methodology strongly favors value, this is good news indeed. While we're proud of our investment methodology and performance over the past decade, if performance leadership is indeed finally shifting to value, we expect a truly outstanding decade ahead. And that's good news no matter what political camp you're in. Until next time, thanks for watching. This is Dr. Jeff Camarda.